guys, it's Nicole, Cypress Property Gal. I'm here today with Thimba Titley. She is my preferred loan partner, and today we just wanted to come together and just kind of look at some of the concerns and most common questions that are asked by first-time home buyers, people who refinance and haven't bought a home in a long time. And so just to bring those questions back to the forefront. So let's get started, and we just want to thank Thimba for being here with us today. And I'm going to ask a series of questions and give her an opportunity. So I'm going to move out of the camera so we can focus back on her and give her an opportunity to answer those questions. So here we go. Let's get started. Okay. Thank you, Thimba, for coming out and participating in this. I really appreciate it.
Absolutely.
We get a lot of questions from our audience about how to get started, what should we do, and any number of questions. We get so many daily. So the first question I'm going to ask is, so what is the difference between a pre-qualification and a pre-approval?
This question should go away, because a pre-qualification is basically a very limited review of a person's financials, employment, assets, and the review is to provide the number to the borrower of how much they are qualified for, meaning how much sales price they would be qualified for. Now, it's very limited, and therefore I feel it should be thrown out of the workplace, because what most people need is a pre-approval. A pre-approval goes beyond just a pre-qualification, and it also matches you with an actual program. So you should never ask for a pre-qualification. You should ask for a pre-approval, because that takes you beyond what you qualify for, but also matches you with what you can be approved for.
Okay. So a lot of times people want to know what documents will be required to provide the lender to get pre-approved. What do they actually need?
We need everything, including your firstborn son. We need documents to verify what your income is. So if you're a wage earner, for instance, we'll need your W-2s for the last 2 years. We'll need your complete tax returns for the last 2 years. We'll need your pay stubs for the most recent 30 consecutive days. That will help us get a picture of what your income is. Then we'll also need to ascertain what your assets are. So if your assets are liquid and in a bank account, we'll need the most recent 2 months bank statements. If they're coming from your retirement account, we'll need the most recent statement from that 401k or the mutual funds to show that that money has been there at least 60 days. So I can't tell exactly what asset documents are required, because everyone has different, methods of savings. So, but assets or reserves, income, we'll also need to review your recent credit report and look at what your debts are, as well as what your credit worthiness is in regards to credit score and things of that nature. So quite a few things depending on what your transaction entails.
Okay, and I want to stay on script, but there was just one thing that you just said, talking about the credit score. One of the questions that I get quite a bit on an inbox is, how does a person check their credit? There are the services out there like Credit Karma. When you get ready to pull the credit, how accurate is the ones that the consumer pulls versus the ones that you as the lender would be pulling? How accurate is that, and how close? Because if I'm speaking to someone, they say, well, I just pulled my credit, it was 600, but then you pull it and it says it's 539. Why is there such a big disparage against that?
Well, I'll start by answering your question by letting you know that the credit world, we'll just call it the world, is not an exact science. I cannot take my crystal ball and give you an understanding of, what your score should be based on your credit worthiness and the things that you've done in the past. It's unfortunate, but it's true. So if you pull what we call a consumer-based credit report, which you have access to with Credit Karma and freefico.com. Those are set up and provided for consumers, and they're not accepted by lenders, by banks, by mortgage companies. So unfortunately, although you have access to those and they're able to provide you with what your credit accounts and the history of those accounts, what's reflected. It's unfortunate that you can't go by the score that they
so
give
basically,
you.
it's just going to give you a general picture for you to see.
Exactly.
Here's what I might possibly need to do.
Right.
Yeah. Okay. So
But
to
for
get
a
an
score,
accurate,
you need a mortgage-based
you need a
report
mortgage-based
that we
report.
have to pull.
Okay. So, what are the most common financing options, and what are the differences? You know, you have the different sets, different criteria. What the most common question is, what kind of loan could I possibly qualify for?
Okay.
You know, I'm a veteran, or I have really good credit, and I know that I could go a conventional or FHA. What are some of those different type options out there?
Okay. Lots of different types. And I don't want to take too much time going into all of them, but let me try and touch on them all.
Okay.
So you've got government loans and you've got non-government loans.
Okay.
Your government loans are going to be FHA, which is a government insured product. You have USDA, which is actually a property eligibility program. So that means it's going to be based on the location. Right. And then you have VA. So VA is reserved for veterans. If you are not a soldier, you need to contact us so we can see if you qualify, because they have very strict rules if you're the spouse of a veteran and whatnot. So non-government loans are going to be under the umbrella of conventional or conforming. So really quickly, I'll go here. FHA loans are required 3.5% down. They are very popular with first-time home buyers because generally a first-time home buyer has blemishes on their credit. And I say blemishes only because a lot of people don't look at their credit until it's not perfect.
Let's just say it's not perfect.
And you may not know it's not perfect until you look to buy a home and pull your credit for the first time.
Okay.
So FHA allows for us to explain away those blemishes. One of the issues with FHA that people don't like is it requires mortgage insurance for the life of the loan. It will not go away no matter how much equity you have in that home. It stays with you until you get out of that mortgage and refinance or sell. Okay?
Okay.
Bottom line. Okay?
Right.
VA, I'll touch on that, is for a veteran, 0 down, no mortgage insurance per month. So a veteran, we take care of our veterans. You've taken care of us. It's our turn to pay you back.
Right.
And
Absolutely.
then conventional, anywhere from 3% down to 5% down. You don't necessarily have to have perfect credit, but they're very strict on the debt.
So this is a caveat to what you just said. You know, sometimes people say, I've been told that it's always, you got to put 20% down. You got to put 20%. Is that still relevant today?
No. Not relevant at all. It's your choice to put 20% down.
Right.
If it's important to you that you do not carry an escrow account, or if you want to eliminate mortgage insurance.
Now,
for
our consumers, I know what the escrow account means, but they don't know our language. So explain what is when you say not carry an escrow account.
Okay. So an escrow account is an account that's attached to your mortgage, and it is set aside by the lender to disperse your property taxes and your hazard insurance.
Right.
So what'll happen is every year, no matter where you live, you owe property taxes. That property tax is typically reflected in an annual amount, but for your escrow account, you pay into it monthly. So if the annual insurance was $1,200 a year, you would pay $100 per month into your escrow account so that at the end of the year, you have enough funds to have your lender disperse it. The same for hazard insurance. If you have your annual hazard insurance amount, you will pay a monthly prorated amount along with your mortgage so that at the due date, the anniversary date, the lender can go ahead and disperse those funds for you.
Okay. All right. And so I think you've already touched on what the differences are. So most people want to know, how much down payment do I really have to have? I was speaking with someone on yesterday, and she was just explaining to me about how they're saving for their down payment. And one of her questions was, how much do I really need to have? And I gave her a few examples based off a lower sales price. So what would you tell our audience about, what determines the amount of down payment?
The program that's selected for you is going to determine the down payment. If you do FHA, 3.5% is your down payment. If you do a conventional loan, I advise that it can be anywhere from 3 to 5%. So those down payment amounts are generated by the program holder.
Okay. All right. And so here's another thing that I get every day, actually. You know, once I'm pre-approved, what is a pre-approval retractable? Can you approve me basically and then come back and say your approval has been declined?
Your pre-approval is going to be set on a list of contingencies.
Okay, now explain to the audience what you mean by contingencies.
Okay, so if a pre-approval is provided by myself, I can speak for myself only, there are going to be quite a few contingencies on the bottom of that pre-approval. And they are going to say that the pre-approval is based on you remaining employed on the same job that you provided the income documents to support. It's going to say that the pre-approval is contingent upon the home appraising for the amount of the sales price that the pre-approval is covering you for. It's going to say that the home must not be a manufactured home or a mobile home, because a pre-approval for that type of home is going to be totally separate than one for, and then the other, a very important pre-approval contingency has to do with title work. The home that you purchase must meet the legal ramifications set by the lender. So, and I don't want to get into that, but you can't take the pre-approval that I'm providing you for, say, a single family home and use it for a condominium.
Right, because it's totally different.
Totally different.
Right.
So those are the normal contingencies. But when you do a thorough pre-approval, your lender should be explaining everything to you. You should not be in the dark about anything. So to go back to the question, is it retractable? It will not be retractable as long as you've been told exactly what you're being pre-approved for, and you understand that you can only buy what's in the box.
So, when I say retractable, in addition to what you're saying, if the information that has been provided has changed, if you no longer have the money for your down payment or your closing costs, those are things that could change the approval.
Absolutely.
Okay. So just to make sure that you understand it, there are some things besides within the guidelines, but there are things that you actually have control over, such as the amount of money for your down payment, your closing costs. If you spend that money, then that's going to change the pre-approval because you would have to have those funds. Okay. So let's move on to how long is my pre-approval good for? I get that all the time.
Good
is
question.
that subject to the lender that you're using, or is it a standard in the industry? 30, 60, 90 days. If I apply today, I don't intend to purchase a home until, let's say, May. Would the pre-approval still be good for me to follow up at that time?
Well, you have to be careful with that. Typically, your pre-approval is based on the credit report, the date that the credit report was pulled. And I say that because certain lenders allow the credit report to be 90 days old and still close.
Okay.
Some only 60 days.
Okay.
So when I pre-approve a person, I also match them with the lender.
Okay.
If that lender's programs require a 60-day maximum credit report look back, then your pre-approval will only be good for 60 days.
Okay.
So, but we do want to be careful, because if you have a person that's pre-approved in January, for instance, it's not guaranteed that they'll remain pre-approved in March.
Yeah. So at that time, if that time expires, then you would have to rescore.
Correct.
Absolutely.
Repull.
Okay.
Repull the credit report, review the income documents, review the asset documents, and make sure everything still falls in line.
The same category
guidelines.
it was. Okay. All right. So the next question I want to go on to is, how long does it normally take to close? I've come across people who have, used other agencies, of course, and they've said it just took so long for them to close. What is a general time frame? With the new trade rules and all, what is a general time frame?
So I first would say define normal. What's the normal time I should anticipate the closing? There's no normal. There is no normal. So what I would prepare you for is 30 to 45 days.
Okay.
However, we go back to the very first question you asked me, which is the difference between a pre-qualification and a pre-approval.
Right.
I pride myself on doing a very thorough upfront pre-approval, where I generally I typically underwrite the file if you
pretty much
before
you get started. Yeah.
Right. That allows us to expose if there's any red flags, any issues, any concerns, and we can deal with them up front before that time clock starts ticking.
Right.
Once I pre-approve you and you go to your realtor, fall in love with a property, and then provide me with an executed contract, the clock is ticking. So that is not the time to realize you didn't have the proper assets to close.
Right, which is, and I'm going to, as a caveat to that, which is the reason why, if you noticed on a video that I did just maybe about a week or two ago, and I said, if you call me, I will not just run out and show you your property. If you call me and say, well, how much is this? How much is that? Of course, we want to be able to help you and lead you and guide you, but just finding out the cost of something doesn't mean that you actually qualify for that. So that's why I'm always going to say to you, have you spoken to a lender? Because that lender is going to make sure that you fall within the categories that you need to fall within.
Correct.
Okay, so let's go on to how are closing costs determined? You may have some down payment, but then you may not have enough for closing costs.
Right.
So let's talk about that for a minute. How are closing costs determined?
Okay, so assuming that you understand that closing costs are separate from down payment.
Yes.
And we've already talked about down payment.
Right.
So your closing costs are going to be the fees associated with actually closing your loan. Okay, so you're going to have quite a few third-party service providers that are important to make the loan go through. Their fees are going to be included in your closing costs.
So before you move on, let's explain to the audience what third party is. First, second, third party.
Okay. So a perfect example would be your title company. Your title company, which is the location where you're going to close. They provide the attorneys to review your documents and make sure you're protected. The notaries that verify your signatures.
There's just a whole gamut.
Yes. But they have their own set of title fees. They're a totally separate company, but necessary in order to make the transition go forward. Your underwriter or your bank, they also have fees that are charged to you to borrow the money that you're applying for. Those are some of your typical survey. If you have to get a survey, the existing owner does not provide you one, that'll be part of your closing costs. So again, part of my pre-approval is to itemize an estimate of what the closing costs will be so that you're in the know and not surprised by what these totals amount to.
Right. And so the last question really, it talks about, how you can assist veterans, and we kind of touched on the programs that are involved with the veterans. I mean, what would you have to say to a veteran that's watching this video right now?
I say use your eligibility. You've earned it. You worked for it. Use it. The Veterans Administration Program, hands down, is the best mortgage program available, but it's only available to you. As long as you can provide me with the documentation, which is your eligibility certificate, to show that you are a veteran and worthy of the assistance, we will put you with the program that funds for veterans. And if you have questions, We also put you in front of the Veterans Administration to help you with any questions, because every veteran is different.
Different. Absolutely, yes.
Yeah, I can't. I can't begin.
They all fall in different categories.
Very much so.
You've got
Very
a
much
lot of
so.
different factors that determine what you can qualify for.
Exactly.
Yeah.
Exactly.
Okay, so as a final thought, what would you say at this point, to the audience, as far as hey, when you're getting started, the very first thing you need to do.
First thing you need to do is pick up the phone and call a reputable lender. Her name is Thimba Titley, 832-256-6296, because I'm going to guide you through the pre-approval process and make sure you understand what's required of you, as well as what's going to be necessary right before you get your keys. Excuse me.
Okay, Tim, I really just want to thank you for taking time out of your day to answer this set of questions. I know that our audience will definitely find this information very useful, and we do intend to do a little bit. I'm going to pull this over just a little bit toward me a little bit. We do intend to do quite a bit more educational videos like this, and I just think that it's just so important to follow the process, and I preach that all the time on my page about how important it is. The very first step is not to go out and search for a home. Maybe you may want to just kind of look around and see what type of community and check out the amenities and things of that nature where you might want to raise your family, things of that nature. But beyond that, the very first thing, like she said, is going to be to contact that lender to find out where you stand, what you can do, and in some cases you may not be in the position to move forward. But if you've taken all of that time and spent countless of hours looking at looking on HAR, looking on Zillow, looking at houses, it's just wasted time. And then you find out that you're not even eligible to purchase a home right now. So follow the process. I just cannot emphasize how important following the process really is. It will save you time. It will save you drama. You will sleep better at night if you will just follow the process. So there you have it. This is Cypress Property Gal. I'm signing out. And if you are still shopping for a home, visit us at www.buyandsellhomecypress.com. I do answer by text, so you can text me at 832-917-3244. And see you again, folks.